The biggest fear that a lot of people have when they retire is whether or not their money is going to be sufficient to take care of their requirements for the rest of their lives, because they're contending with the rise in prices, inflation. It's eating out of everybody's pocket. Now, what I'd like to discuss today on Moneywise is how an individual should plan their investments to get a regular income while also protecting their capital and ensuring that it is sufficient for the rest of their living years. And we've got several instruments to talk about, several options to talk about. Joining me to talk about all of this is Harshvardhan Roongta, the co-founder of Roongta Securities. Harsh, thanks so much for joining in and for speaking to me today.
It's absolutely a pleasure to be on the show always with you, Alex.
So, I have listed out a few options, Harsh, and we'll talk about what works and what doesn't. But the most popular choice that individuals have, even my own father, till I had to nudge him and push him and say, please invest in equity, said, I'm going to manage everything with fixed deposits. And you won't believe it. If he's listening to this, he will probably have some words for me. But he has Excel sheets where he's listed out which fixed deposit is maturing when, and he's got this detailed calculation going into 3, 4, 5, 7 years. And this is how a lot of people invest, right?
That's correct. So in fact, making a list of the fixed deposits with their maturity dates, etc., is a very common practice. I mean, I don't think he's singled out in that context. I mean, we see most of the elderly people maintaining, and because they may not be tech savvy to maintain everything online, so they will have a book or a ledger kind of a thing where they'll note down these things. So I think it's very common to have this kind of a record keeping done by a senior citizen. So that's fine.
So fixed deposits and interest from fixed deposits is one. The second is rent. And a lot of people in that age group right now have properties, because people in 2010 or 2000, after the financial crisis, you had that big crash in property, and a lot of people went out and bought at that time, right? So we're talking about now in 2025, when a lot of people have 2 properties. It's not something that is odd, and so therefore that income is a relevant source of regular income, right?
So, Alex, if you look at a post-retirement requirement, your basic requirement is that you need regular income to manage your expenses. Now, how do you get that regular income? Okay, so if you already have properties that you've built over a period of time during your working years, so one is that you have for primary occupation. The other is an investment. So if you've accumulated something over a period of time, so you have 1 extra property or 2 extra properties, and now you've retired. So if you are generating rent on that property, it's fine. Yeah. There's nothing to complain in that context, right? However, the problem arises that post-retirement, the corpus that you accumulate, the financial assets that you have, if you plan to convert that into a real estate,
which shouldn't be done.
So that is not going to be practically prudent. I'll tell you why. So assume a situation that you accumulated 1 crore of rupees over a period of time, and now at 60 you have access to that money to yourself. It could be through provident funds, could be through retirement benefits, etc. Now you say that I will go and buy a property worth 1 crore, on which if I get rent, I mean, it should be good enough. It won't work out, because a residential property yields, the rental yields for residential properties is about 2 to 3%. Yeah. So if you're putting a 1 crore property on rent, you're expecting about 2 to 3 lakhs.
Yeah.
Now, out of that 2 to 3 lakhs also, you have to take care of the property. There's repair, maintenance, there's going to be property taxes, there's going to be society maintenance charges. So essentially, what are you left with after paying those expenses is what your cash flow is going to be, which is going to be minuscule.
Yeah.
So situation 1, that you've accumulated properties over a period of time,
which is fine.
So now it's you've paid off all the loans, etc. Now it is without any loans. So now there is a property on which you're going to generate rent. That's fine. But if you plan to buy a property out of your retirement corpus, it may not be the best thing to do.
And we'll delve into each of these aspects in a bit, because I want to talk to you about the ideal scenario and how an individual should ideally construct their portfolio. But the third option that I listed down is dividend income. And I've come across a lot of people that are trying to build portfolios of companies that traditionally pay higher dividends, something like a Power Grid Corporation of India or PFC or REC, a lot of these public
ITC
sector,
for them.
or ITC, right? So, but is that a legitimate way or a good way to generate income post-retirement?
So yes and no, both. Again, the situation is that if you have sufficient quantity of those shares, okay, because again, the dividend yields are going to be in the range of 1 to 2% of the market value. I'm not talking about your cost of acquisition.
Right.
So at retirement, whatever is the market value, you can expect about 1 to 2% as a dividend yield. Now, assume that you've accumulated those shares in good quantities. Then, of course, the dividend that comes in is more or less, your cost of acquisition will be lower.
Sure.
The dividend that these companies announce is more or less predictable. I mean, I wouldn't say it is predictable entirely, but more or less in a range. Now the question arises, are you willing to bet on that predictability? That like ITC is going to give a dividend of 5% of their profits. So are you willing to bet upon all of that? So it's something that you need to be careful about. In particular year, if they don't announce that much dividend, then how are you going to survive?
Sure.
So while I would say that don't depend on dividend income, but if you built up a sizable corpus over a period of your working life, then dividend can supplement your other fixed sources of income that you may have.
Okay. Now, an extension to this is income distribution cum withdrawal, which is an option in mutual funds, which essentially, and here also there is no periodicity that is fixed, but on an ongoing basis, these schemes are supposed to distribute income as opposed to the growth option, which reinvests everything into the scheme itself. Is this an option?
So, well, I would say that you should not depend on it.
Okay.
I mean, see, if I were to retire and I would say that, okay, I have certain investments in mutual funds, and if and when they announce dividends is going to be my cash flow, and I'm going to meet my monthly expenses out of that. So how confident are you going to be with that?
Because it's not fixed.
It's not fixed. Yeah. The quantum is not fixed. The periodicity is not fixed. So how would I survive on a monthly basis depending on something that may not come to me? So I don't think it's a wise decision to depend on it. But however, of course, if you have invested, and dividends are not tax efficient because they are added into your
slab rate.
In your slab rate. But if you are within the 12 lakh category right now,
now from next year, yeah.
So it may be tax free, but I don't think that it's a very wise decision to depend for monthly expenses through dividend income.
Okay. So IDCW is essentially out. REITs and InvITs, this is now to the point that you were making. Going out and buying a property fresh with the proceeds of whatever you've accumulated over your career is not a good idea. But if you want income from real estate, you can have fractional ownership and you can have a portion of your portfolio which allows you to invest in these REITs, which are publicly listed, or InvITs, which is infrastructure investment trusts, where you're supposed to get a regular income. And that's the purpose of these vehicles. Is this an option to consider?
So again, this could be additional. It could complement the other sources of fixed income, but it cannot be the only source of income. Again, because see, with REITs, at least there is some visibility. Okay, that you will get some amount of money every month or every quarter, every 6 months, whatever. There's going to be some kind of money coming in. But would you want to depend? My question is, would you want to depend on that frequency or that variability for your monthly expenses? So post retirement, do you want to take that kind of a stress on yourself to say that, okay, I'm going to get something from my REITs, the investments that I made in REITs? I don't know how much, I don't know when, and it could fluctuate, right? So do I want to get into that zone?
But here the amount that you get and the yield is relatively higher, right?
Yeah, so you could expect about 8%, 7 to 8% kind of a yield from your REITs. I mean, that's your expectation, though there is no guarantee, of course.
Yeah.
But the kind of returns that you can expect from REITs would be around in the range of 7 to 8%.
Okay. So you're saying you shouldn't depend on this. This is something, again, that bolsters your income, but don't depend on it?
Yes. So the underlying point I'm trying to make, imagine a person who's retired. The primary concern of that person is that I should get one fixed amount every month. Now, how do I get that? Okay, it could be an interest income, so there is visibility. I know that I'm going to get so much amount. If you already have property, which you've accumulated, which you've kind of built over a period of time,
not the monthly rent.
So you know the monthly rent. So there's predictability.
Right.
That I'm going to get this much amount every month. That secures that person, mentally to say that, okay, fine, I am going to get this particular amount every month. In addition to this, okay, my dividend income will also come in. That will bolster my cash flows.
Sure.
Okay, I could have some REITs which will pay me something. Okay, I can have that in addition to my basic primary source of income. So you will have to structure your investment in such a way. One portion has to be fixed. Okay, and the other portion could be variable.
Sure.
Okay, so again, I have certain cases that we've been listening to or getting to know that people even preferred immediate annuities for this purpose.
I was going to come to that next, right? Which is a lot of people do invest in annuity products, and also a lot of people that will eventually have NPS, the National Pension Scheme maturity, where they're forced to put money into these annuity products. Personally, I don't like these products because they are, in my opinion, restrictive. And I do want to ask you, Harsh, in the conversations that you have with people that come to you, your clients, do you advise them to go for annuity products?
So now, if it's a very specific question to people whom we are talking to, no.
And why is that?
The answer is clear no, because of the restrictions that you will have. So imagine that you retire with a corpus of 2 crores.
Yeah.
Okay, and you say, okay, I'm going to park this money entirely into an immediate annuity plan.
Right.
So you take that 2 crores, you park it in an immediate annuity plan. It's a voluntary, right?
Yeah.
Unlike an NPS where there is a compulsion to put 40% into an immediate annuity.
Right.
Yeah, in this case, what you're doing is you're doing it voluntarily. So why would you undertake that? One, because you do not want liquidity on the principal that you accumulated. So that's the only primary purpose.
You don't want to have it accessible because you don't want to have a dent in it.
Correct. So suppose a person comes, he says, look, I've accumulated 2 crore rupees. Now I don't want access to this money. Okay, at any point in time, I may be influenced or threatened, for that matter, or could be anything. I may be forced to remove money out of that corpus that I have built and give it to somebody or my family members, whatever. I don't want that situation to arise. So what I do is I park this money in an immediate annuity plan where even I don't have access to it anymore. I get a fixed income every month for the rest of my life,
right,
based on the annuity option that you take. Okay, so this takes the capital out of your hands. There is no flexibility. The returns that you generate on an immediate annuity plan will be in the range of about 6% or so. So it's not a very efficient product. As you rightly said, there are restrictions. So the people whom we speak to, I mean, we wouldn't encourage something like this. Now you broaden the horizon, because we're talking to people, I mean, there could be different demographics of people all across the country. So there could be a couple whose children may not be living with them, but they may be under constant threat from their children to say that I need money. Why don't you just break your FDs and give it to me? I'll return it back to you.
Sure.
There could be moral blackmailing, I mean, emotional blackmailing. There could be lots of things threatening to them.
So conditionality is important.
So they may feel under that pressure to always have that, because if such children see money with their parents and they will say like, why aren't you giving to us? We are already having so much of problems, etc. So they may break that FD and give it to the child. If a situation so arises, then they're left with no money for the retirement, for the take care of the retirement expenses, post-retirement expenses. So a couple like this would be better off parking their money straight into an annuity plan. So even they don't have access to it. So there's nobody who can force them to do anything. So there are different people, different circumstances. There are different options available. You have to be a little wise in understanding what works for you. So people who are speaking to us, like you said, you're not comfortable, you're financially savvy.
Yes.
Not everybody in this country is. So you need to be mindful of how do you give a solution to somebody based on their understanding, their specific conditions. So I think there are a lot of options, but you just be a little wise in deciding what works for you.
The last one that I wanted to talk about is not something that we speak about very often. And after we discuss this, we'll talk about the ideal scenarios, right? But reverse mortgage, and this is where, for those people that are wondering what this is about, if you have a property, you can go to a bank, and a lot of the large banks do offer this as an option, but most people don't consider it. You effectively are giving the bank the property, and you're taking the value of the property, and you receive this over a period of time. Am I right about that? And then once your lifetime is over, the bank takes possession of the property, and you have no more liabilities.
Okay, so let me explain this it's called reverse mortgage, right? So we're talking about mortgage.
Yeah.
So what happens when you take a home loan? So you buy a property,
and the property is hypothecated to you.
Yeah, it's your property, which is as a mortgage to the bank.
Yes.
And you pay an EMI to the bank.
Correct.
Okay, and at the end of the loan tenure, the property becomes yours.
Yes.
This is reverse mortgage.
This is the bank paying you an EMI.
Correct. So what do you say? That I have a property which I'm living in right now. Okay, I don't have any other source of income. I cannot sell this property and go somewhere else. So I continue to live in that house. At the same time, I'm encashing it. So what do you say that, okay, I am, like, for example, selling in that context, I'm selling this property to a bank, and the bank, instead of paying me a lump sum right now, pays me installments every month till the time I'm living. So I get money every month while staying in that house. Okay, it's a reverse EMI. So now the bank is giving you money, and post your lifetime, the bank takes possession of that property and then sells it off and recovers the money that they have given to you over a period of lifetime. So this works again very well for people who do not possibly have dependents or they don't want to pass this on to somebody else. There could be situations where couple is living alone, the children are away, they don't intend to take care of them, or whatever the situation.
Or they can't.
Or they can't, whatever. An elderly couple may think that, okay, I am going to be suffering entire life of mine where I don't have cash flows. Post my demise, this property goes to somebody else. Instead, why don't I enjoy it? I live in it, at the same time I can encash upon it.
Yes.
And post my demise, the bank takes it over.
So, but do you know anybody who's done this?
No, not in my personal references, but and I don't think it's been very popular because, typical Indian mindset, we're very emotional about our property. We don't want to...
but it is a Western concept. Ultimately, it is something that a lot of people I think, if I'm not mistaken, in the US have contemplated.
So, because there are different, sentiments with different people in different countries. For example, in the US, particularly in developed countries, for that sense, the moment a child is an adult, they move out of the house, they have their own house. So, there is no reason for them to then, if an elderly couple wants to give it to somebody, and they suffer, that doesn't work like that.
Yeah.
So this concept being available is a good thing.
Yeah.
Okay. Imagine this not being there.
Yeah.
Even if one person in one city requires something like this, it should be available.
Okay. So we've discussed several options, but the one option that we've not talked about, which I wanted to spend a little time with, is mutual funds, right? And equity mutual funds, hybrid mutual funds, also your entire portfolio, right? So we're talking to people right now who are going to spend the next decade, 2 decades, who've already spent a decade in certain cases, or 2 decades investing in mutual funds and created a corpus. They're retiring now or will retire in 10, 15, 20 years. Is there a case to be made to use SWP? And usually, what is normally advised, and a lot of people speak about, is that as you reach your retirement, you de-risk.
Correct.
And you move out of equity and you reduce your equity. Is that something that you advise as well?
So, there are different combinations that you can use. But we started this conversation with you saying that you're not comfortable in immediate annuity, right?
Yes.
You mentioned for yourself.
I did, yes.
So let me take your example, for instance. So you are an individual who's financially savvy. You understand, you have reasonable control on your behavior.
Yeah.
So we put that into perspective. Now, hypothetically, Alex, you've over a period of last 25 years, suppose you're approaching retirement now, you've been investing for 25 years. So you put in, say, 10,000 every month with no increment, okay? Just 10,000 every month for 25 years.
Yes.
And which grows at 12%.
Right.
Okay. At retirement, you will accumulate almost 2 crore rupees, 1.9 to 2 crores.
Sure.
So say for, calculation purposes, understanding purposes, it's 2 crore of rupees.
Right.
So I repeat the situation. You've been investing 10,000 rupees for 25 years. Okay. So, and now at retirement, you accumulated 2 crore of rupees.
Yes.
The capital that you've invested is 30 lakhs.
Sure.
Against which you're standing at a corpus of 2 crores right now.
So 1.6, 1.7 crore
is your
is
profit.
Yeah.
Okay, that's your margin.
Right.
Or the profit margin that that you're sitting on. Now, when you retire, what if I say that why don't you leave the 2 crores as it is in equity fund itself, which is contrary to what people...
I was just going to say, doesn't that fly in the face of what a lot of people say, which is de-risk? Move out of equity. What if the equity markets fall 20, 30% in a year?
Exactly. So now I go back to the profile of the investor. So I'm talking about you right now. So you've understood the market cycles. You've been a financial journalist and you've been all of that bit. So at 60 now, when you're sitting at 2 crores of rupees, your invested capital is 30 lakhs. Now you say that I want 1 lakh a month.
Right.
Okay, so you set up an SWP, a systematic withdrawal plan. Right. Out of this 2 crores, you're taking 1 lakh every month. Okay. Now, hypothetically, markets fall 20%. Your 2 crores corpus comes down to 1.6 crores.
Yeah.
Why would you even flinch? I'll tell you why. Because you have invested only 30 lakhs. You're sitting at 1.6 crores even after market fall. You need this money not immediately. but you need it over the next 10, 20 years of your lifetime.
Yes.
You understand markets have their cycles.
Yes.
Okay, even if it falls to 1.6 crores, you can still very well take 1 lakh every month out of this and not exhaust this capital for the next 10 years.
And the markets will rebound eventually.
So because you know that,
Yeah.
right? You know eventually markets over a period of time will again rebound. So you have that risk-taking capacity. What your objective was, regular income, which you have got now in the form of 1 lakh a month. What you also need to do is take care of inflation post-retirement. Now, this equity investment helps you even take care of inflation post-retirement perpetually. Your corpus in this case shouldn't exhaust even when you cross 80 years of age. So in next 20, 30 years, you have no worry.
So, but then this is the mutual fund investment that you're doing, right? You're doing 10,000 rupees as in your illustration. But what about the rest of my portfolio, in my example? Because as a salaried employee, I also get your employee provident fund. There may be certain fixed income investments that I have. All of that will come to me post-retirement. So what do I do with that?
So see, at any point in time, I'm assuming when you started your SIP of 10,000 rupees 25 years ago, that time also you had asset allocation in mind.
Yes.
Okay, so there was some portion that you would also build debt. Post-retirement, when you have accumulated 2 crores in equity AUM, you would also get these retirement benefits, which will need to go into debt.
Right.
You need to have an asset allocation between debt and equity.
Right.
My focused concern was only in so much that sometimes we tend to go too much by the thumb rule and forget that our individual circumstances could be different.
So if you don't have liabilities, if you don't have, if you have a house of your own and all of those other aspects, you don't have financial dependence at that stage, what you're saying is to keep your investments wherever they were at that point. But also, I guess, to a certain extent, you would have to go through your equity allocation of your portfolio at 60, and you can't be, having an overexposure to a small cap space, right, at that point.
So now so that was of situation 1.
Yeah.
Now that is for a investor profile like yourself.
Yeah.
Okay, let me just complete that cycle of saying there could be another investor profile who's not so financially savvy.
Sure.
Who doesn't want to take so much risk even at that point. So even if you explain that 20% market fall, still you're far in excess of what you've paid.
Yeah.
So there's nothing to worry. But there would be somebody who doesn't want to take that kind of risk. So there are hybrid funds where they can switch into from equity. You don't need to be, the point that I'm trying to drive is that you don't need to fear equity as much, because your cost of investing, you've averaged for 25 years. Take advantage of that.
Okay.
Don't kill that at the time of retirement.
Yeah.
You may go into a conservative hybrid, you may go into an aggressive hybrid, balanced. That's a different story.
Because the velocity and the momentum will continue far beyond if you keep it invested. And at that corpus size, you're talking about, even if you're going 8% in a year, you're talking about a very substantial increase in the corpus.
Absolutely right. So my only limited point is that do not just switch into debt for the sake of switching.
Sure.
Maybe you could do better.
Yeah.
Like if you are not being advised or assisted and then you're on your own, then it's better to go into something that gives you comfort, which is just simply move to fixed deposits. But in case you are financially savvy, why would you give up on the benefits of compounding and averaging that you've done over 25 years? Now at the end of it, when you're supposed to take the benefits, you just moved out of equity.
And just the last point on systematic withdrawal plans, which a lot of people don't factor in, is the tax efficiency of this, right? Because that 1 lakh rupees in this illustration, not all of it is what you're paying tax on, right?
Yeah, correct. Because there's a FIFO system, the first in, first out.
Right.
So the units that you redeem, the cost of those units are also a part of that 1 lakh that you're redeeming. So the cost minus whatever is your gains, you'll pay tax only on that. So it's a very tax efficient way of doing it. My only point is that do not be driven by certain thumb rules.
Yeah.
If you are financially savvy, don't just think that a person at 60 cannot take risk. I mean, if you have nothing better to do and you've averaged it over 25 years, why can't you take that risk?
Yeah.
Provided, of course, you understand what you're doing, you understand the market cycles, you believe in the Indian economy, you believe that the economic cycles will be there, eventually India will grow. If all those things are in place, why would you want to get out of it?
On that note, thank you so much, Harsh, for joining in and for this lovely conversation.
My pleasure, Alex. Thank you so much.
That brings us to the end of this edition of Moneywise. It's been an absolute pleasure bringing it to you. Do stay tuned for a lot more on NDTV Profit.